Imagine this. You roll out of bed, glance at your phone, and that bank balance stares back like a bad joke. Barely enough to cover the basics. It's the same story every day, right? Your salary hasn't budged in years, yet the world around you feels like it's pricing you out, one latte at a time. But what if I told you the villains aren't just rising costs or global chaos? What if the real thief in the night is a shadowy mechanism that's quietly drained trillions from your future, funneling it straight to the elite few at the top? Buckle up, because today, I'm pulling back the curtain on America's greatest financial heist, one that's been unfolding for over 4 decades, and it's hitting your wallet harder than you ever imagined. Let's start at the ground level, where most of us live, the grind of everyday America. Picture the 1980s, Reagan's era of big dreams and bold promises. You could snag a modest home on a single paycheck, fill up the tank without flinching, and still tuck away a little for the kids' college fund. Fast forward to now, and that same dream feels like a relic from another planet. Rent's through the roof, groceries are a monthly gut punch, and forget about saving. You're just trying to stay afloat. The talking heads on TV? They love pinning it on inflation, whispering that it's temporary, a blip caused by pandemics or wars halfway around the world. Supply chains snarled, they say. Demand outpacing supply. Fair enough, but I've dug deeper, and those explanations are like smoke screens, hiding the real fire raging beneath. What if the squeeze on your finances isn't some accident of fate, but a deliberate design? Over the past 40 years, from the dawn of the Reagan Revolution through the tech booms, crashes, and everything in between, the U.S. economy has ballooned into a behemoth. GDP has tripled in real terms. Corporations rake in profits that would make kings jealous. And yet, for the average worker, you, me, the folks punching clocks from coast to coast, real wages have flatlined. That's right. The buying power of your paycheck today matches what it was back in 1980, dollar for dollar. No gains from all those iPhones, algorithms, or assembly line wizardry. It's as if time froze for the middle class while the world sped ahead. But here's the twist that keeps me up at night. All that economic magic didn't vanish into thin air. It went somewhere, straight into the vaults of the ultra-wealthy. Think about the hidden gears turning behind the scenes. In the post-World War II glow, up through the 1970s, America ran on a simple pact. Workers hustled harder, produced more, and shared the spoils. Factories hummed, innovations sparked, and paychecks swelled right alongside output. It was a golden age of shared prosperity, where a rising tide lifted nearly every boat. Unions had muscle, taxes on the rich were steep but fair, and regulations kept the game balanced. Your grandparents' generation built empires on that foundation. Homes, cars, retirements funded by one steady job. Then, in the late 1970s, the winds shifted. Oil shocks rocked the globe, stagflation gripped the nation, and a new breed of leaders, think Reagan, Thatcher across the pond, preached deregulation like gospel. They slashed taxes on corporations and the elite, gutted union power with laws like right-to-work statutes, and unleashed Wall Street to run wild. Globalization kicked into overdrive, outsourcing jobs to cheaper shores. And quietly, almost imperceptibly, the rules of the economic game were rewritten. No grand conspiracy meeting in a smoky room, just a series of policy tweaks, lobbying wins, and boardroom decisions that tilted the board in favor of owners over laborers. By the 1980s, this new order was locked in, and the divergence began. Now, let's escalate this. Follow the money trail and you'll uncover a chasm that's grown into a canyon. Since 1979, American workers have boosted their productivity by more than 80%. That's hours of sweat turning into smarter machines, faster software, and leaner operations. Companies like Apple, Amazon, and Exxon have minted billionaire after billionaire on that efficiency. The stock market? It's rocketed from a Dow of around 1,000 in 1980 to over 40,000 today, a 40-fold surge. National wealth has exploded to $150 trillion. But where's your cut? For the bottom 90% of earners, wages have crawled up just 30% in real terms over the same stretch. The top 1%? Their incomes have ballooned by over 200%, fueled by stock options, bonuses, and capital gains taxed at bargain rates. Zoom in tighter, and the inequality sharpens to a knife's edge. The richest 0.1%, those hedge fund titans and tech moguls, have seen their slice skyrocket by 400%. It's not just pay, it's assets. In 1980, the wealthiest families held about 30 times the net worth of middle-class households. By 2022, that's doubled to over 70 times. The top 10% now control nearly 70% of all U.S. wealth. Stocks, real estate, you name it, while the bottom half scrapes by with a measly 2%. This isn't the Gilded Age reborn, it's on steroids. Back then, robber barons like Rockefeller amassed fortunes amid public outrage. Today, it's normalized, packaged as meritocracy, with billionaires launching rockets while families couch surf. And the smoking gun? It's this beast called the productivity pay gap. For decades after the war, productivity and typical wages danced in sync. Up 2%, pay rose 2%. Double the output, double the reward. But post-1979, they split like a bad breakup. Productivity soared on the wings of tech and trade deals, but wages? Stagnant. Why? Enter the mechanisms I mentioned. Declining union bargaining power, dropped from covering 30% of workers in the 1970s to under 10% now. Minimum wage? Frozen in real terms since the 1960s peak. Corporate tax rates plummeted from 50% to 21%, freeing up billions for buybacks and dividends instead of raises. Offshoring and automation? They juiced profits, but left workers competing with ghosts. Jobs vanishing to factories in Asia, replaced by algorithms that don't need health insurance. The financial implications? They're catastrophic. And they're compounding like interest on a maxed-out credit card. That $50 trillion figure I hinted at earlier? It's the total wealth shift from the bottom 90% to the top 10% between 1980 and 2022, calculated by economists tracking where all that productivity bounty landed. Per household, that's over $300,000 vanished from your potential nest egg, siphoned into yachts, private jets, and tax havens. It's why home ownership rates for young adults have cratered from 45% in the 1980s to under 35% today. Student debt? Ballooned to $1.7 trillion as public funding for education shriveled. Retirement? Social Security strains under the weight, while 401s for the masses lag behind the market's feast. But here's why this matters right now, in 2024, more than ever. Inflation's the scapegoat du jour. 8% spikes post-COVID, they say, eroding your savings. Sure, prices hurt, but it's a symptom, not the disease. The real erosion happened long before, baked into a system where gains flow upward. We're in an era of AI revolutions and green energy booms that could create trillions more in value. Without fixing this gap, it'll just widen. Your job automated away, profits padding executive suites. Policymakers dither with band-aids like stimulus checks,
But the structural theft continues.
And with elections looming and markets jittery, ignoring this invites deeper crises. Social unrest, political populism, or worse, a full economic unraveling like the 2008 crash, but on a grander scale. So, as we wrap this investigation, let's reflect on the road ahead. You've seen the blueprint now, the policies, the gaps, the trillions redirected. It's not hopeless. Awareness is the spark. Demand fair taxes, stronger labor laws, investments in education and infrastructure that lift all boats. Protect yourself. Diversify beyond wages, side hustles, skills in high-demand fields, community investing. But more than tactics, this is a call to reclaim your stake in the American story. The system was redesigned without you once. Don't let it happen again. Your financial future isn't a spectator sport. It's time to step into the arena. What will you do with this truth? The clock's ticking. Imagine if I told you that for decades, you've been pouring your sweat and ingenuity into the American economy, only to watch the rewards vanish into a shadowy network of corporate maneuvers. Trillions of dollars siphoned away, leaving you scraping by while the elite soar higher. This isn't some conspiracy theory. It's the hidden engine driving the greatest wealth shift in modern history. You felt it in your stagnant paycheck, but what you might not realize is how deliberately it's been engineered. Buckle up, because we're diving deep into the mechanics of this economic heist, and by the end, you'll see why it's reshaping your future right now. Let's step back and paint the picture of this quiet revolution that's been unfolding since the late 1970s. Picture yourself in a factory, an office, or behind a desk, places where everyday Americans like you have been cranking out more output than ever before. Your tools are sharper, your processes streamlined, your ideas sharper. Yet, as that productivity surges, your slice of the pie shrinks. Workers kept getting more productive, generating more value per hour of work, but their paychecks stopped keeping pace. Since 1979, worker productivity has increased by over 70%, but wages for typical workers have grown by just 12%. This isn't a glitch. It's a feature of a system that's quietly funneled the fruits of your labor elsewhere. To grasp the scale, consider your own family story, or one that mirrors millions. Say you step into the role your parents or grandparents held: the assembly line operator, the teacher, the truck driver. Back then, they toiled with the tech of their era, producing at a steady clip. Now, with automation humming and efficiencies kicking in, you're squeezing out nearly double the results in the same time. That 70% boost? It's real economic magic you've helped create. But instead of a fatter wallet reflecting that growth, you're lucky if your income matches theirs, even after accounting for the creeping rise in everyday costs like groceries and rent. The surplus, the extra wealth born from your enhanced efforts, doesn't evaporate. It streams upward, padding the fortunes of those at the top. CEOs in corner offices, investors lounging by pools, and faceless shareholders whose grip on the markets tightens with every passing year. We're talking about a colossal redirection, dwarfing any single policy or scandal. Over 4 decades, this has amounted to trillions in value. Value you generated, redirected from Main Street to Wall Street, all under the guise of business as usual. But here's where it gets intriguing. This isn't happening by accident or through some invisible hand of the market. No, it's orchestrated through clever, often obscure tactics that have rewritten the rules of corporate America. Let's peel back the layers on the first of these. A practice that sounds innocuous but has become a powerhouse of inequality: stock buybacks. Rewind to the early 1980s, a time when the U.S. was shaking off the stagflation of the 70s and embracing Reagan-era deregulation. Before then, if a company wanted to repurchase its own shares, it was viewed with suspicion, like insider meddling that could distort markets. Regulators treated it as borderline manipulation, allowing it only in narrow, tightly controlled scenarios. Then, in 1982, the SEC flipped the script with Rule 10b-18, essentially giving corporations a green light to buy back their stock en masse, as long as they followed a few procedural hoops. What followed was an avalanche. Fast forward through the decades, and these buybacks have ballooned into the single largest channel for redistributing corporate cash, not to workers or innovation, but straight to the pockets of those holding equity. Take the S&P 500 companies, the titans of American business. From 2003 to 2012 alone, those 449 heavyweights funneled a staggering 54% of their net income. That's over $2.4 trillion, right back into repurchasing their own shares. Add in dividends, and it jumps to 91% of earnings devoted to shareholder perks, leaving crumbs for R&D, infrastructure, or, crucially, the people doing the actual work. Why this obsession? Follow the money trail to executive boardrooms. In today's corporate landscape, leaders don't get paid in straightforward salaries anymore. Over 80% of CEO compensation comes in the form of stock grants and options, high-stakes bets on the company's share price. When they greenlight a buyback, they shrink the pool of available shares, jacking up the value of what's left. Suddenly, their personal net worth skyrockets, all funded by the profits you helped generate. It's a self-reinforcing loop. Prioritize financial tricks over real growth, reap the rewards in your portfolio, and justify it as maximizing shareholder value. The suspense builds when you see how this plays out in real crises. Remember 2017, when the Tax Cuts and Jobs Act slashed corporate rates from 35% to 21%, pumping billions in extra cash into company coffers? In the very next year, S&P 500 firms unleashed $806 billion on buybacks and dividends, more than double the prior year's total. Or zoom to 2020, the pandemic's brutal grip. Unemployment lines snaked around blocks, small businesses shuttered, families teetered on the edge. Yet, amid the chaos, these same giants shelled out $521 billion on stock repurchases. Imagine that money redirected toward retaining staff, bolstering supply chains, or even community relief. Instead, it propped up stock prices, shielding executives from the downturn while you navigated layoffs and uncertainty. This isn't isolated greed. It's systemic. Every buyback dollar is a missed opportunity for wage hikes that could lift families, for training programs that build skills, or for expansions that spark jobs. You've been conditioned to celebrate rising stock indices as economic health, but they're often just smoke and mirrors, masking a deeper erosion of the middle class. As if that weren't enough, there's a second layer to this web, one that's even more insidious, rooted in the raw power dynamics of modern markets. Since the 1980s, a wave of mergers, acquisitions, and lax antitrust enforcement has consolidated industries into fortresses controlled by a handful of behemoths. Think about it. Airlines, tech, retail, pharmaceuticals, sectors where once dozens of competitors vied for your business now bow to a few dominant players. Data from economic trackers paints a stark reality. Across 157 key U.S. industries, in 91 of them, the top 5 companies command at least 80% of the revenue pie. This isn't the competitive chaos of the post-war boom. It's a throwback to the Gilded Age of the early 1900s, when trusts like Standard Oil crushed rivals and dictated terms. Right before progressive-era laws stepped in to break them up and restore balance. Sex. This concentration wields a double-edged sword against you, the worker and consumer. With fewer options, companies hold all the cards in hiring. Why offer competitive pay when talent has nowhere else to go? Wages stagnate, bargaining power evaporates, and unions, once a bulwark, wither under the pressure. On the flip side, with rivals scarce, prices climb unchecked. Your grocery bill, your cable package, your prescription drugs, all inflated beyond production costs. It's a pincer movement. Earnings squeezed at the bottom, expenses ballooning at the checkout. Economists call this the wage price squeeze, but the numbers scream it louder. Corporate markups, the gap between what it costs to make a product and what corporations charge, have exploded threefold since 1980. Back then, firms pocketed about 21% above marginal costs. Today, it's a voracious 61%. That's not efficiency. That's extraction. Billions leached from your wallet into profit ledgers that haven't swelled this much since the Roaring '20s, right before the Great Crash exposed the rot. Now, let's escalate this to the heart-pounding implications. What does all this mean for the economy you've built your life around? This dual assault, buybacks draining resources upward and monopolies squeezing from the sides, has supercharged inequality to levels that echo the most unstable eras of U.S. history. The top 1% now capture a share of national income rivaling the pre-Depression peaks, while median households tread water. Productivity's gains, meant to lift all boats, instead fuel asset bubbles. Skyrocketing home prices you can't afford, stock surges that benefit the wealthy, and a gig economy that trades security for scraps. Innovation? Stifled, as concentrated power chokes out startups and experimentation. And the ripple effects? A hollowed-out middle class, fraying social safety nets, and political influence skewed toward donors who thrive in this setup. We've seen it spark unrest, from Occupy Wall Street to today's labor strikes. Yet the machine grinds on. Why does this matter right now, in 2022 and beyond? Because the post-pandemic recovery is testing the system's fault lines like never before. Inflation's roar, supply chain snarls, and geopolitical tensions are amplifying these distortions. Companies are reporting record profits, over 12% of GDP, the highest in a century, yet wage growth lags, buybacks hit $1.5 trillion last year alone, and mergers keep rolling despite FTC warnings. If unchecked, this could tip us into a stagnation trap, growth without shared prosperity, where AI and automation widen the gap further, leaving you more productive but poorer. Governments are stirring, bids to curb buybacks revive antitrust, but lobbyists fight back fiercely. The urgency? Your retirement, your kids' opportunities, the very stability of the American dream hang in this balance. So, as we close this investigation, reflect on the quiet theft unfolding daily, the value you create, the power you unwittingly cede. It's not hopeless. History shows reform is possible, from the New Deal's labor wins to today's grassroots pushes for fairer markets. But it starts with seeing the strings. Next time you hear about booming corporate earnings or a hot stock market, ask, who's really winning? Demand transparency, support policies that tie executive pay to worker gains, and champion competition that levels the field. You've powered this economy. Now, reclaim your stake. The revelation is out. What will you do with it? Imagine this. You're standing in the checkout line at your local supermarket, watching the total climb higher than last month, and the news blares on about runaway inflation devouring your hard-earned dollars. But what if I told you that's only half the story?
a carefully crafted smokescreen hiding a far more ruthless heist. A silent raid on your wallet, engineered over decades, where the real culprits aren't faceless global forces, but the very companies you work for and buy from. Buckle up, because I'm about to pull back the curtain on how America's economic engine has been rewired to siphon wealth straight from your pocket into the vaults of the elite, and why ignoring it could cost you everything you've built. Let's start at the surface, where it hits you hardest. Right in the gut, every time you swipe your card. Picture the landscape of corporate America in the early 1980s, a time when deregulation was the buzzword and Wall Street was rewriting the rules. Back then, businesses began flexing unprecedented muscle, not from groundbreaking inventions or streamlined operations, but from a simple, predatory edge. The power to hike prices without a fight while squeezing every last dime from their workforce. Fast forward to today, and those elevated markups I mentioned earlier? They're not anomalies. They're the blueprint of a profit machine that's ballooning corporate earnings to heights unseen since the Roaring '20s. You're paying more for the same groceries, the same gas, the same everything, while your take-home pay flatlines. It's not bad luck or bad timing. It's by design. But here's where the intrigue deepens, like a thriller unfolding in the shadows of boardrooms across the nation.
While headlines scream about inflation as the big bad wolf, there's a subtler force at play, one that's been building since the Reagan era's wave of mergers and monopolies. You see, companies aren't just raising prices, they're wielding market dominance to extract what's yours, under the radar. Economists whisper about it in hushed tones, rent-seeking, a fancy term for when giants like big tech or big pharma lock in their turf, then harvest the surplus value without lifting a finger to innovate. Think about it. Supply chains snag, sure, and geopolitical storms brew. But those are the distractions. The real sleight of hand? Blaming uncontrollable forces to deflect from the corporate playbook that's funneled trillions from Main Street to the penthouses. I want you to lean in closer now, because this is where the suspense ratchets up. You've been conditioned to see inflation as the villain, the visible thief picking your pocket at the pump or the produce aisle. It's tangible, infuriating, and it demands your attention. But peel back that layer, and you'll uncover the invisible machinery grinding away. A wealth transfer orchestrated through policy shifts and corporate maneuvers that date back to the 1980s antitrust rollbacks. Wages? They've barely budged in real terms since then, even as the economy's output skyrocketed. Productivity? American workers are churning out 70% more value per hour than in 1980. Yet that bounty doesn't circle back to you. Instead, it's rerouted through stock buybacks that juice executive pay, dividends that fatten shareholder coffers, or mergers that crush competition. The inflation story? It's the perfect alibi, steering your outrage toward abstract forces while the structural theft hums along unnoticed. Escalate this picture in your mind. It's not just numbers on a screen. It's your daily grind turned against you. Envision yourself clocking in at the office or the factory. Your skills sharper than ever, thanks to tech that's transformed every job since the personal computer boom of the '80s. You're faster, smarter, handling twice the workload with half the effort. Maybe that AI tool slashes your email time, or automation streamlines your assembly line. In a fair world, that surge in efficiency would mean a fatter paycheck, right? Wrong. What happens next is the heart of the con. Your company tracks every metric: revenue per head, profit margins ticking up like a thriller's plot twists. But that extra value? It vanishes into the ether of financial optimization. They slap on markups that pad the bottom line, then deploy the windfall not to reward you, but to engineer windfalls for the top. Stock prices soar on buyback announcements, CEOs cash in on performance bonuses, and investors, from hedge funds to your 401k's distant cousins, reap the rewards. Meanwhile, you're left chasing the same rent, the same bills, wondering why your parents' generation could buy a house on one income while you juggle 2 gigs. This isn't ancient history. It's accelerating right now, and that's what makes it so urgent, so chilling. From the dot-com bubble of the late 90s through the 2008 crash and into the pandemic-fueled boom of the 2020s, the patterns have only intensified. Corporate profits now claim nearly 12% of GDP, levels that echo the excesses before the Great Depression, while labor's share has plummeted to post-World War II lows. Why does this matter in 2022 and beyond? Because the stakes are existential. As climate disruptions and AI revolutions reshape markets, this entrenched power ensures the gains flow upward, widening the chasm between the haves and have-nots. You're not just treading water, you're fighting a current designed to pull you under. Policies like tax cuts for the rich since the 80s and lax enforcement on monopolies have supercharged it, turning the American dream into a rigged casino where the house always wins. And let's zoom in on one arena where this extraction hits like a gut punch. The housing crisis that's gripped the nation since the foreclosure waves of the late 2000s. Remember the subprime meltdown? It wasn't just a blip. It cracked open the door for vultures to swarm. Over the last decade, private equity behemoths, think Blackstone or Invitation Homes, have swooped in, snapping up over 500,000 single-family homes across the Sun Belt and beyond. They pay cash, outbid families like yours at auctions, and flip them into rental empires. Suddenly, that starter home you eyed? It's off limits, locked behind corporate leases jacking rents 20 to 30% above market. This isn't investment. It's enclosure on a massive scale, echoing the land grabs of the Gilded Age, but supercharged by low-interest floods post-2008. Tenants pour in monthly checks, funding billionaire portfolios, while homeownership rates for young Americans crater to 1980s lows. It's a microcosm of the broader theft. Your aspirations, your stability, harvested for someone else's gain. As we pull back from this web of deception, reflect with me on the bigger truth staring us down. Since 1980, we've witnessed an economic transformation disguised as progress. A shift from shared prosperity to concentrated control. You've powered this machine with your sweat and ingenuity, yet the gears are oiled with your deferred dreams. The inflation fog is lifting, but only if we demand to see the full picture. Not just higher prices, but the systemic siphoning that's left workers poorer amid unprecedented plenty. It's not too late to rewrite the script. Question the narratives, push for policies that claw back market power, stronger antitrust, fair wages tied to productivity. Because in the end, the real wealth isn't in those inflated stocks. It's in reclaiming the value you've created. The choice is yours. Stay in the shadows, or step into the light and demand your share. What will it be? Imagine this. You're pouring your hard-earned paycheck into rent every month, watching your dreams of owning a home slip further away, while shadowy investors rake in billions without lifting a finger to build anything new. What if I told you this isn't just bad luck? It's a calculated heist on the American dream, engineered over decades to siphon wealth from your pocket straight into the hands of the elite. Buckle up, because I'm about to pull back the curtain on the invisible machinery that's been quietly reshaping our economy since the 1980s, turning opportunity into extraction and leaving you footing the bill. Let's start where it hits closest to home, literally. Picture the neighborhoods you grew up in, the ones where families once built generational wealth through a simple mortgage. Today, those same streets are battlegrounds in a silent war over housing. Institutional investors, massive funds backed by Wall Street titans, swoop in, snapping up single-family homes by the thousands. They don't renovate or expand, they just flip the script. Suddenly, what was your potential starter home becomes someone's rental trap. You, the aspiring buyer, are priced out, forced to hand over your monthly earnings not to build equity in your future, but to pad the portfolios of distant shareholders. But here's where it gets insidious. This isn't some organic market shift. It's a deliberate insertion of middlemen who profit by standing between you and ownership. Those rent checks? They don't vanish into thin air. They fuel a relentless machine. Investment firms pool the cash, leverage it to acquire even more properties, and tighten the noose on supply.
Fewer homes for sale means skyrocketing prices for what's left. Prices that soar beyond the reach of teachers, nurses, and factory workers like you. And as demand for rentals surges, landlords jack up the rates, trapping you in a vice of escalating costs with no escape hatch. It's a loop that feeds on itself, converting the stability of home ownership into a perpetual cash cow for the few, while eroding the foundation of middle-class life. By the early 2000s, this pattern had accelerated, with private equity giants like Blackstone leading the charge, amassing empires from the ruins of the 2008 crash. What began as opportunistic buying has evolved into a full-scale takeover, quietly reshaping communities from Detroit to Dallas. Now, zoom out, because this isn't isolated to rooftops and picket fences. The same playbook unfolds across the economy, a web of extraction that's as interconnected as it is ruthless. Take private equity firms, those voracious players who've ballooned in power since the Reagan era. They don't create, they conquer. Storming into healthcare, they gobble up doctors' offices and hospitals, not to heal, but to harvest. Staff get slashed, corners cut on care, all to squeeze out fatter margins for their investors. Nursing homes? Acquired, understaffed, and optimized for payouts, leaving vulnerable elders in the lurch while profits flow upward. Retail chains fall next. Think of your local stores loaded with debt through shady maneuvers called leveraged buyouts. The firms pay themselves lavish dividends from borrowed money, then watch as the debt crushes the business, jobs vanish, and communities hollow out. I've dug into the filings, the whistleblower accounts, you name it, and the pattern screams. No new value added, just redirection. Workers' sweat, customers' loyalty, entire towns' vitality, all funneled from the ground up to the penthouses of finance. By the 2000s, these firms controlled trillions, their tentacles in everything from pet food to prisons, turning public goods into private toll roads. And it's not just efficiency, it's exploitation dressed as innovation. Remember the 1980s deregulation wave? It cracked open the doors, letting these wolves in sheep's clothing roam free, preying on sectors once buffered by oversight. But wait, it gets deeper, darker. Enter the pharmaceutical labyrinth, a trillion-dollar fortress built on your desperation and the public's dime. Rewind to the post-war boom. Taxpayer-funded research at universities and labs birthed breakthroughs, insulin refinements, cancer fighters, everyday lifesavers. Fast forward to today, and Big Pharma swoops in, patents the discoveries, and slaps on prices that defy logic. A pill costing pennies to make? It hits the shelf at hundreds, sometimes thousands per dose. Not because of R&D magic or supply chain woes, but pure monopoly muscle, courtesy of government-granted patents that stifle generics for years. Those windfall profits? They don't fuel the next cure. Instead, they're diverted to stock buybacks,
propping up share prices to juice executive bonuses and lavish C-suite paydays. Sick patients, you and your loved ones, foot the bill for treatments no one can refuse, hemorrhaging wealth to a cartel that's mastered the art of legalized gouging. This isn't the market rewarding genius. It's a rigged game where public investment seeds private plunder. Since the 1980 Patent Act expansions, drug prices have ballooned 1,200% adjusted for inflation, while innovation stalls. Fewer new drugs, more Me Too tweaks. The suspense builds. How long until the next epidemic exposes this fragility, with cures held hostage for profit? Shift gears to the credit machine, that everyday predator lurking in your wallet. Banks and card issuers, empowered by 1990s financial loosening, have weaponized debt into a wealth vacuum. Overdraft traps, late fees, sky-high interest. These aren't accidents. They're engineered strikes. You bounce a check by $5? Bam! $35 penalty, not tied to any real cost, but calibrated to your breaking point. Switch banks? Good luck. The big players own 80% of the market, leaving you captive. Psychologists on payroll design these snares, preying on life's chaos. A forgotten bill, a tight month. It's behavioral banditry, extracting billions annually from the working poor who can't afford alternatives. From the 1980s credit boom to the subprime explosion, this system has ballooned household debt to $17 trillion, turning necessities into nooses. You're not a customer. You're prey in a system where fees alone generate more profit than actual lending. As we connect these dots, the full picture emerges, a seismic pivot in America's economic soul. Back in the 1950s and 60s, growth meant shared prosperity. Companies innovated, workers unionized, communities thrived. But starting in the 1980s, under the banner of free markets, a counter-revolution took hold. Financial engineering eclipsed real production. Profits from clever debt tricks outpaced factory output. Productivity soared, tech, globalization. But the gains? Hoarded by asset holders, not spread to you. Why does this matter now, in 2022's fractured landscape? Because the cracks are widening. Inflation bites, wages stagnate, yet asset prices, stocks, real estate, balloon for the top 10%. The 2008 crash was a warning shot. COVID accelerated the frenzy, with billionaires doubling wealth while evictions loomed. This isn't ancient history, it's the air you breathe, the policies echoing from Reagan's tax cuts to Trump's deregulatory dash. And underpinning it all? A tax code twisted into a wealth accelerator. Capital gains, your investment's profits, taxed at half the rate of your paycheck. Why work when speculating pays better? Corporate rates plummeted from 35% in the 80s to 21% today, freeing billions for buybacks over wages. Estate taxes, meant to break dynastic chains, gutted, allowing trillions to pass untouched, entrenching inequality across generations. Layer on the regulatory rollback. Glass-Steagall's 1999 repeal unleashed casino banking, birthing the 08 meltdown. Labor laws eroded, union membership halved since 1980, robbing you of leverage. Antitrust? Dormant, letting tech behemoths and pharma giants consolidate power unchecked. From 1980 to now, mergers exploded, markets concentrated. 4 firms control 80% of beef, 2 dominate seeds. It's a recipe for capture, where competition yields to collusion. So, as the sun sets on this era, reflect with me. We've traded the promise of broad opportunity for a gilded cage, where extraction trumps creation, and your labor funds their leisure. But knowledge is the first spark of change. The system's not invincible, It's sustained by silence. What if you, armed with these truths, demand reform? Push for fair taxes, robust regs, real antitrust. The American economy can pivot back, but only if we expose the thieves and reclaim what's ours. The clock's ticking. The choice is yours. Imagine this. You're grinding away at your job, pouring your energy into building something valuable, only to watch your paycheck shrink while the world around you gets richer. What if I told you this isn't some random twist of fate? It's the blueprint of a financial system that's been quietly rewired over the last 4 decades to siphon your hard-earned value straight into the pockets of the elite. Buckle up, because we're diving deep into the shadows of America's economic engine. From the boardrooms of the 1980s to the trading floors of today, and uncovering how it's all connected to the struggles you feel right now. Let's set the stage here in the United States, where the story really kicks off. Back in the late 1970s and early 1980s, the economy was humming along with a certain balance. Workers had leverage through strong unions and regulations that kept big businesses in check. But then, something shifted. Policies started to erode those safeguards, and antitrust laws that once shattered corporate giants like Standard Oil faded into irrelevance. Market power consolidated, and the scales tipped dramatically. This wasn't chaos, it was calculated. Over the next few decades, a series of deliberate decisions reshaped the landscape, all under the banner of free market ideals. Picture the Reagan era unfolding in Washington, D.C., with its bold promises of deregulation and tax breaks for the wealthy. Economists and policymakers preached that unleashing corporations from red tape would spark a boom for everyone. Trickle-down magic, they called it. Cut taxes on the rich, loosen banking rules, and watch growth lift all boats. But as we peel back the layers, you'll see the truth. Those boats never rose for the average American. Instead, what emerged was a precision-engineered machine for redistributing wealth upward, straight from the labor of everyday people to the coffers of owners and executives. It's not theory gone wrong. It's theory working exactly as designed, if you squint at it through the lens of who benefits. Now, let's zoom in on the beating heart of this transformation, the financial sector. Once upon a time, banks were straightforward. Simple bridges linking savers' deposits to borrowers' needs, fueling real growth in homes, businesses, and communities. Fast forward to the 1990s and 2000s, and they've morphed into something far more sinister. Colossal engines of extraction, churning out profits through labyrinthine products that prey on the very system they dominate. Think about it. High-frequency trading bots, zipping through millions of microtransactions per second, skimming fractions of a cent each time. They don't create jobs or innovate. They just erode value from your retirement funds, your 401k, siphoning it away in invisible fees that add up to billions annually. But it doesn't stop there. Dive deeper into the derivative markets, those shadowy corners born in the deregulated frenzy of the 80s and exploding post-2000. These aren't tools for hedging risk. They're weapons for manufacturing chaos. Credit default swaps, for instance. Remember the 2008 crash? They let big players bet against the economy's success, profiting wildly from failures they helped engineer. Imagine speculators wagering on your neighbor's mortgage collapsing, turning human hardship into their windfall. This isn't accidental volatility. It's engineered scarcity, pumping up trading volumes and fees while the real economy stutters. And here's the kicker. As finance ballooned from a slice of GDP in the 1980s to nearly 8% by the 2010s, corporate America pivoted hard. CEOs ditched R&D budgets and employee training for stock buybacks and leverage deals. Financial wizardry that juices executive bonuses but starves innovation. Escalating the stakes, Consider the ripple effects across the board. This financialization isn't isolated. It's infected every corner of the economy. By the 2020s, with tech giants and Wall Street behemoths holding unprecedented sway, we've seen profits soar, not from making better products, but from gaming the system. Amazon warehouses hum with worker output, yet wealth concentrates at the top through algorithmic efficiencies that cut wages and corners. Airlines merge into oligopolies, hiking fares while squeezing labor. Even the gig economy, Uber, DoorDash, it's all built on this model, extracting value from drivers and deliverers via apps that promise freedom but deliver precarity. The data is damning. From 1980 to 2022, the top 1%'s share of national income doubled while median wages stagnated. That's not growth. That's a heist in slow motion. Why does this matter right now, in 2024, as you scroll through headlines about recessions or AI booms? Because the extraction machine is accelerating. Post-pandemic stimulus propped up markets, but who got the real gains? Not you, staring at rising rent and grocery bills. Inflation gets the blame, but it's a smokescreen. Your dollars are vanishing, not just to higher prices, but because the system, tweaked through laws like the Gramm-Leach-Bliley Act in '99 or the gutting of Dodd-Frank, has rigged the flow of value. Pensions erode from trading fees. Home ownership slips away as Wall Street scoops up properties for rental empires. And with climate crises and geopolitical tensions brewing, this fragility could snap. A market wobble today isn't random. It's the downstream tremor from decades of prioritizing shareholder returns over societal stability. As we wrap this up, I want you to lean in close. Understanding this web isn't some academic exercise, it's your armor. That nagging sense that the game's fixed? You're right. From the policy pivots of the 1980s to the trading algorithms of tomorrow, it's all one thread, a 40-year blueprint for capture. But knowledge is the spark. If enough of us see past the distractions, the culture wars, the quick-fix gurus, we can demand the changes. Revive antitrust teeth, bolster worker voices, rein in finance's excesses. Your financial future isn't doomed. It's just obscured. Peel back the curtain, share what you've learned, and let's rewrite the ending. The system's not invincible. It's just waiting for us to expose it. What will you do next?